Well, good afternoon, everyone, and apologies for the delay there, but we'll get started here. So it's an honor to be here today in this collaborative webinar brought to you by MCT and Freddie Mac. MCT with its forward-thinking approach to capital markets and mortgage technology, combined with Freddie Mac's commitment to making home possible for millions of homeowners, today brings together a wealth of expertise and insight. So today we're going to delve into a current economic outlook by Freddie's senior economist, economic and housing research, Ajita Atreya. Affordable lending strategies by Freddie's affordable lending manager of single family, mission and community engagement, Mia Jones. And technology solutions by myself, senior director and head of MCT's client success group, Paul Yarbrough. So without further ado, let's get started. To start off, we will hear from Ajita with a current economic outlook. So Ajita, I'll let you go from here.
Thank you so much, Paul. Hello, everyone. Thank you so much for joining us today. Very excited to be here today to talk to you all about the economy and the housing market, where we are and where we are headed. Before I dive into the details, let me just give you an overview. So on the economic front, the US economy has shown resilience even in the face of the rising interest rate, and we're expecting that the second half of the 2023 is going to remain stable. And the optimism about the stability in the economy comes from the fact that consumers have been resilient so far. And the reason why is because your labor market remains strong with unemployment rate at 50-year lows. Consumers have substantial savings to draw on, which likely will continue to slow as the inflation is still high. And inflation continues to slow from its peak in September of 2022, but it remains above the Fed target of 2%. And we're going to go through that in a bit. On the housing market front, we all know that mortgage rates increased seeing that home buyers are going really strong. If you go to the next slide, what I've plotted here is the next slide. If you could go to the next slide. Yes, so what I've plotted here is the real consumer spending. And the spending grew at an annual rate of 3% as of July 2023, which is at pre-pandemic level now, which is the February 2020 levels. And the reason consumers are able to spend despite inflation, despite high interest rate, is because the pandemic recession was the first recession where consumers accumulated trillions of dollars in excess savings. Well, there are various estimates of the savings accumulated by consumers, but most estimates suggest that total savings accumulated to be greater than $2 trillion. Almost half of it is now spent, but still have $1 trillion in excess savings. And on top of that, the labor market has been tight. In the next slide, you can see the jobs are growing at 2% rate, which is the very left chart. There are about 1.5 jobs per unemployed person, which is the middle chart. And when we look at the S&P earning calls, we are hearing less and less mention of job cuts, which is a good thing. And it's compared to earlier this year, they're mentioning less of the job cuts in their earning reports. But if we drill down a little more into the labor market, in the next slide, you can see that we added around 187,000 jobs in August. And these numbers get revised almost 3 times. Each month gets revised 3 times. And what seemed a little concerning is during the recent revisions, every initial non-farm payroll employment report through June of this year has been revised down, and the cumulative change in non-farm payrolls is approximately 325,000 fewer jobs than they were originally reported, which is a little concerning. But the good news is, even with these revisions, the economy has still added 1.5 million non-farm payroll jobs through the first 6 months of this year. And this is of course, a slowdown from where it was in 2021 and 2022, but it's well above the pace of job growth for the year prior to 2020. And the current unemployment rate is at 3.8%. And if we look at the unemployment rate by state, here the darker blue indicate that the unemployment rate is higher there. For example, California and Nevada in the west, Texas and Kentucky in the south, Illinois in the Midwest, and DC, Delaware, New Jersey, New York in the Northeast have unemployment rate higher than the national average of 3.8%. So as I mentioned earlier, consumer balance sheet improved significantly on the pandemic-related stimulus, but it's slowly depleting. If you look at the bank deposits, which is the left chart here, it has been slowing down from its peak of $18 trillion to $17.3 trillion. The middle chart shows the personal saving rate, and personal saving rate is down to 4.3%. Before the pandemic, the saving rate was running at around 7 to 8%. If we look at the credit card and other revolving credit on your right, we can see that it's growing and has reached $1 trillion in revolving credit, which is concerning. Therefore, consumer spending, which is the backbone of the US economy, is likely to slow down as households exhaust their pandemic-related excess savings and start to feel the bite of the higher interest rates on credit cards and other variable rate debts that they have. Now, we cannot end the economy section without talking about inflation, right? So in the next slide, here are different measures of inflation. On your left, inflation is still well above the Fed's comfort zone. Fed's favorite to track is the PCE, or the personal consumption expenditure, which is also above 4%. So while the inflation is moderating, it's still above the Fed's comfort zone of 2%. So what is keeping this inflation high? So to illustrate that, on your right is a chart which shows the contribution of various components to the inflation. In 2022, energy prices were a big contributor, but now it's the shelter prices, which is shown in the green color there, which is rent prices. And now we are hearing again that the energy prices are going up, shelter prices are rising again, which might mean that inflation remains higher for longer. So that's the narrative we've been hearing a lot, higher for longer. And inflation remaining sticky might push Fed to raise rates again, which means that mortgage rates may go even higher than where it is today. And putting it all together, while we're optimistic about the economy, some caution is warranted given new developments in the economy, which includes your student debt resumption, your rising energy prices, your auto worker strikes, government shutdown, which was avoided temporarily, but it's just like kicking the can further down the lane. So we are optimistic, but cautiously optimistic about the economy. Now, let's look at the housing market and what's going on in the housing market. The first slide here is the mortgage rates, and the housing market, as we know, has been plagued by high mortgage rates and tight inventory. And the rate that you see here is as of 9/21. We have a new rate that came out this month, and brace yourself to hear that mortgage rates have reached 7.49, which is the highest level since 2000. So it's in a generation, we haven't seen rates as high as 7.49, and it has remained and stayed above 7% for over a month now. And if you look at the dispersion in rates, it has risen dramatically. So for consumers, it's always beneficial to shop around. Fortunately, most homeowners have locked in a low interest rate through a fixed rate mortgage. Thus, they are not as sensitive to interest rate as they might have been in the past. But this also means that they are locked into their current homes, which I'll talk about in a bit. But for prospective buyers, affordability is a major hurdle to get into the home ownership. And in the next slide, the chart there shows the affordability index that the National Association of Realtor produces. And this housing affordability index measures whether a typical family earns enough income to qualify for a mortgage loan on a typical home at the national and regional level based on the most recent price and income data. And an index below 100 signifies that, which you can see now, it is below 100. It signifies that family earning the median income do not have enough income to qualify for a mortgage loan on a median priced home in that area, assuming a 20% down payment. And we can see that from around mid 2022, affordability index is below 100. Most of the month, this is almost around the same time when the mortgage rates started rising above 5%. So now mortgage rates have consistently been above 6%. It has reached 7. It has reached 7.49%. So affordability is eroding every week. And rapid decline in affordability has led to contraction in the purchase market. And here you can see the two leading indicators of the home sales. On the left is the pending home sales. On the right is mortgage applications. Pending home sales increased by 0.9%. However, August data is now, we have August data, and pending home sales slid 7.1% in August compared to a month ago. And as rates are rising, they have also reduced the pool of home buyers who are having to kind of readjust their expectation about the location and the type of the home that they can afford. And therefore, the pending homes is sliding down, and compared to a year ago, it's 18.7% less in pending home sales. Similarly, purchase application on your right is also down significantly. The dotted red line is the weekly index for year 2023. Week to week, there is, of course, volatility, but it's clearly below all the years listed on the chart. Compared to a year ago, purchase applications are down by 27%, which means that we are going to see, even slimmer home sale numbers in the coming months, since mortgage apps and pending home sales are what will turn into the sales in the coming months. Now coming to the home sales, if you go to the next slide, what you're looking at here on the left is the total home sales. Compared to a year ago, total home sales are down by almost 12%. They are running at around 4.8 million annual rate. And if you look at that circle there, that's the home sales in 2020 and 2021, and they were 1.2 million above trend, which means that sales were likely pulled forward when the rates were low. And if we look at the regional sales, all the regions have been slowing down in terms of the sales. So sales are weak, but we are seeing that prices are going strong. In the next slide, I have home prices. On your left is the year-over-year price growth. On the right is the month-over-month price growth. Home prices grew at 2.9% in July on average, and month-over-month it grew by 0.7%. And again, as of last week, we have August data as well, and home prices have grown by 4%. It's not 2.9% anymore. And the rebound started in the beginning of the year. But the price growth at regional level, it varies. If you go to the next slide, we can see that in the West, we are seeing negative price growth for a few months now. Again, this is as of July. August numbers are out as last week, and this is changing. The states are changing a little bit. It's again getting blue, more blue than red. But as of July, we were seeing, price fell in the Western region, but there is price growth in the other part of the country. And despite all the issues around rates and affordability, why hasn't home prices come down yet? And it's because there is a mismatch between demand and supply in the housing market. There is demand in the housing market, but supply is not catching up. And to illustrate that, I have a few slides here. On your left is the inventory, the month supply number, and the housing market, as I mentioned earlier, is plagued by lack of inventory. And one of the measure of the inventory is month supply, which means at a current sales rate, how many months of supply is available for sale. And it hasn't improved much in a long, long time. There are 3.6 months of supply available in the market nationally. It's an improvement from 2.4 months of supply, which was the lowest, but not a whole lot, because a healthy market requires 6 months of supply, and none of these markets, as you can see in this map here, is where the supply is greater than 6 months. So we are really, really, tight on inventory. And the reason we have a lack of supply is because construction has been behind for many, many years. New house on your right is the new housing completions. It shows that the completion improved in 2022, but it's still below the great financial crisis levels. And if you look at the entry-level supply on the next slide, entry-level supply has been declining for decades, and that's where most of the demand is concentrated at. By entry level, I mean construction that is 1,400 square feet or less, which is really hard to see these days. In the 1980s, over 30% of the construction was entry level, but now it's down to 10%. The other reason why the inventory is low is because the existing homeowners are being locked in at a very low mortgage rates. Due to mortgage rate lock-in effect, existing homeowners are unwilling to list their homes for sale. And in this chart, you can see that the listing of existing homes are down by 35% as of April 2023, compared to pre-pandemic average of the 2016 and 2019 levels. And we do not expect sufficient existing homes to come on the market anytime soon to boost these existing homes available for sale. Until homeowners get accustomed to these high rates, unless people have to move for a job or family reason, it doesn't make economic sense to forego these low rates, probably below 3%, and go for high rates. So less likely that we'll see existing home listing grow soon. So the supply is really, really tight. But at the same time, demand is high. Housing market remains resilient due to the demographic tailwinds, especially the first-time home buyers. What you can see here on the left is when you look at the change in number of different type of buyers in the most recent 12-month period, we can clearly see that compared to 3 years pre-pandemic average, there are over 32,000 more first-time home buyers today, which is 9.1% more first-time home buyers. So they are the driving force in the housing market. And in terms of potential in the market, there are 3.4 million renter households between the age of 25 and 44 years who could potentially be first-time home buyers. So the good news is that there's a large generation of first-time home buyers who will drive demand in the housing market, but the bad news is that we don't have enough houses out there to offer to them. And the housing market will remain resilient also because even if homeowners are hit by negative income, let's say the economy slipped down, they're hit by negative incomes, rising home prices have helped build equity for existing homeowners. There is almost 29 trillion available in home equity, which is 5 trillion over what we saw during the boom in 2006. and up almost 10 trillion since 2019. And if we were to, equally divide this 29 trillion among the homeowners in the US, it's on average $315,000 in equity, which is 100K more than that they had at the onset of the pandemic. So that creates a lot of buffer saving if hit by adverse impacts. And the demographic trends that I discussed are at the moment up against high mortgage rates and an unusually severe lock-in effect that's restricting the supply. So to deal with affordability issues and the availability issues, home buyers are flocking to many small and medium-sized metros. And in this chart, you can see the metros where the greatest influx is. Most of the people are moving to 6 metros in Florida, 2 in Texas, 1 in Carolina, makes 9 out of 10 metros from the southern region. In terms of losses, Miami is losing some heat in terms of the in-migration, but still growing in prices. Now, let me end with some cherry note here. Despite all the issues that we have seen in the housing market, home ownership rates have been growing. And very interestingly, in our recent research, we find that homeownership rate has been rising for below median family income household amid all the supply issues and the affordability issues that I mentioned today. There was a steady decline in below median family income homeownership rate following the global financial crisis, but the below median family income homeownership rate has been quickly increasing since 2016. It's back to 53.4% as of Q1 2023, which is 5.4 percentage point higher than in 2016. And the strong growth in the below median family income homeownership rate may seem unexpected given the strong house price growth since the pandemic, and more recently the jump in the borrowing cost. But nonetheless, below median family income households are overcoming all these constraints and finding ways to become homeowners even within a less affordable environment, which is an encouraging sign for the housing market. So with that, I would like to end here and pass it over to Paul again. Thank you so much for your attention.
Ajita, that was awesome. What a ton of information and impressive speed at getting through that slide and giving us all that those details there. So thank you again, Ajita. And that's a great segue on the below median income, because now we're going to talk to Mia Jones from Freddie Mac, and again, she's the affordable lending manager for single family and mission and community engagement.
What you do with us. It's not just us, it's all of you. So we're talking about not only our loan officers who we love so dearly, but our developers, everyone within this ecosystem, including local governments that help find ways of making home ownership possible for so many people. So we thank you for your partnership with this endeavor, because it really is a big lift, a heavy lift for us, and a big task that we want to continue to strive to even improve on. So on the next slide, we're going to talk a little bit about what Freddie Mac does. We don't lend to the consumer. A lot of, when I talk to people, one of the things that they always say when I tell them I work for Freddie Mac, the first thing they say is, well, can I get a loan? Sure, you might be able to get a loan. However, we want to make sure that you know that we at Freddie Mac do not lend to consumers. What we do is we lend to, we buy loans from mortgage companies, such as those of you who are on this call. We then package those loans and we sell them and on the secondary market. So what we do is really more to provide liquidity, as the previous slide had said, to make sure that there's money continually flowing in this business to make homeownership a possibility. So what we do here, and you'll hear me talk about that a couple of times throughout these few minutes that I have with you, where it is our mission. It is that we're doing everything. We're leaving no stone unturned to make sure that there are opportunities extended to everyone. Okay. So on the next slide, we'll go right into what we do in our department. You heard Paul introduce me as an affordable lending manager. And what exactly does that mean? And what are you guys doing over there, if that's the question that you have? Well, we have 4 foundational pillars. They're insights, mortgage products, education, and business solutions. I'm actually going to go into all of these in just a moment, but I want to give you a highlight of what that looks like. Insights would be what Ajita just gave, providing you with information, thought leadership, research. We have all of this information on our website as well. So, and it may not necessarily be the slides that you see. However, there's plenty of information that speaks to those very things. So we're here as a trusted source, a resource for you to make sure that you have all the tools and resources that you need in order to be an effective leader. We also offer mortgage products, which I'm going to go into, because we understand that not one product fits all. So we're going to talk about a couple of products that we have and what they do and how they work, just so that maybe there's something that you didn't realize that was a possibility for someone. Maybe you're out in the field and you're hearing from someone, well, I want to do a reno project. Well, Freddie Mac has something for that. And then we have education, because we're huge on education. We believe that an informed borrower is a prepared borrower, right? And so we understand a lot of our partners out there have resources for training and home ownership information. But what we want to do is we want to make sure that there's information out, that we're providing some information as well, and that we're giving all the resources that you need. And then we're going to tell you with business solutions how to put all that together, give you everything that you need in order to be successful. So let's kind of dive right into the insights. Insights are great, right? Why? I mean, this is a lot of information on this slide, but I'm just going to highlight it. Really, what this is basically saying is that there are a lot of things that we're providing you to keep you informed, not only so that you'll be aware of it, so that you can leverage and grow your business, because that's what we're here to do, to help you grow your business. We're also here to help you with your clients. If there is something that you need as far as advertising, we have pamphlets, we have resources, we have our website. Everything is absolutely free. So we want you to be able to take advantage of that, and for your clients to do that as well. We also want you to be able to shine. We want you to be a trusted advisor and a leader in the industry. So yes, we're going to give you everything. I want everybody to say, wow, that's a smart person. I really like them. They really helped me a lot. So we want to make sure that we're giving you everything that you need. Okay, so we'll go on to the next slide and we'll talk about some of the challenges that we hear in the market. Down payment. First-time home buyers consider down payment as the #1 barrier to home ownership. So what is Freddie Mac doing about that? Well, #1, we're offering low down payment solutions like our Home Possible mortgage. Now, all of our products are conventional loan products, which is great, because when you're talking about cost effectiveness, sometimes you'll find that the conventional products are cheaper, right? So we offer Home Possible. This is a program that's tailored to a person who is at 80% or below the area median income. So what that means to your borrower is if you have a borrower in an area where it's a high cost area, we'll allow, this is the perfect product for them. It's not only for purchase, but you can refinance with this as well, as long as they fit the criteria that's set in our guidelines, okay? For those who are outside of the 80% or over 80% of the area median income, we have our Home One mortgage, right? That is another option, an opportunity for a borrower who doesn't have 20% to get into a home with less down. And even with our HFA Advantage, that's a supersized version of our Home Possible. We like that one because it just has so many extra benefits that we're going to talk about a little bit later. Okay, so the purpose of Freddie Mac being able to provide all of this is, again, is to create opportunities for someone who might not otherwise be able to buy a home, especially if down payment is a hurdle to them. That 3% down, can I tell you this, that that down payment can come from somewhere else. Someone get married, we can take those gift funds, and we can use that to pay the down payment and closing costs. So the good thing about the Home Possible mortgage on a one-unit property, you can do that. And there are so many other benefits to that product. So if you're not familiar with it, please reach out to us. Please look at our website. All of the information is out there. We want you to be well educated. We want you to provide those opportunities and make sure that you're putting your borrower in the best product that's for them. Because again, not one product fits all, okay? All right, on the next slide, we're gonna talk about a little bit about what some other products that we offer. I mentioned that we had several products. This is where I wanna talk a little bit about Green Choice. Green Choice is for those who are wanting to go green, obviously, right? You can finance certain things, and you can get this mortgage, this special project for that, and those aren't cash out refinances. We have Choice Home. We have for your manufactured homes. We have Choice Renovation. If someone is living in the home and they want to keep it, they want to stay in that home and just renovate it. Remember, Ajita mentioned that there was a lot of equity. It was trillions of dollars of equity in homes. A lot of people are tapping into that equity to make that home because they don't want to buy a new home, number one, because of the shortages, right? The other thing is that maybe they're happy in their home and they just want to expand it. So we offer a lot. We offer different products for different borrowers. Again, there's no one size that fit all. So these are educating yourself and learning more about these products, and even offering these products will put you in the forefront of the industry. It'll definitely make you an industry leader. Okay. And then the next one, on the next slide, we're going to talk a little bit about some other things. I talked about the third pillar being business of education. Education is key in this, especially what we're finding out as I'm talking with lenders and we're working with our clients. We're finding out that education is really, really key here. A lot of times what we're finding is that there isn't that they don't qualify for a mortgage. Some of them just don't know that they qualify. So what we do is we provide a lot of resources. Our Credit Smart has been relaunched. It's been around for over 20 years. It was relaunched in 2021. It is awesome. It's an educational, full capability website, and it provides everything. If you want to know how to get from starting to finish, and when I say finish, I mean in the home, and now what do I do now that I'm in the home? If you want to know all of that information is in there, and we offer that absolutely free to everyone. Our Credit Smart is in English, and recently we opened it up in Spanish, so we're excited about that because we understand that English is not everyone's first language. Imagine how hard it is in this industry when English is your first language. Can you imagine what that is like? So what we do is we're offering that Credit Smart Home Buyer U in Spanish, so that anyone who needs to get that credit education in order to buy a home, that they can, and they can understand the material. We also have some other products, like we're working with FHFA and Fannie, and we've got this clearinghouse where there are documents that they can get to understand the mortgage process from beginning to end. and someone that can actually help them with that. The other thing that we're doing is we have our borrower help centers and we have our resource centers. We have counseling networks because there's some out there that can't do it on their own and they know that they need a little help. We have them covered. So we have a plethora of resources for anyone. And I won't say that we've taken away all excuses, but I want to say we kind of have. We've provided everything that they need in order to be successful. So please continue to hang in there with us so that we can give you all the information that we have and that we can continue to work with you to make your borrowers more informed. Okay, and on the next slide, I'm going to speed up a little bit because we're going to just talk about it's easier to do Freddie, do business with us now. We're going to provide you with everything. We're going to give you 800 Freddie. You can call them throughout the day and ask them to help any question, whether it's a guide question, whether it's a bulk sale, whether it's just a general question about what does someone do in a certain situation. We can help with that. We're also providing, of course, all rates. All of our resources and our guidelines are on our guides. So we want you to certainly continue to use that resource. We're going to offer an industry presence. You'll see us at different events. You'll see us at the NAM events, the NAREP events, the NAREV events. We're all over there. We're out there in the field talking to everyone about what we're doing, the good things that we're doing here at Freddie Mac. And on the next slide, we're going to talk a little bit about the last thing that I want to share. I want to spend just a second on this because I want to tell you that the benefit, you hear us talking about affordable lending, right? You hear, well, why affordable? Well, the affordable, why it's important to us is because we want to make sure that we're extending those opportunities. We want to make sure that there's equality and something for everyone. And if anyone wants to be in a home, they shouldn't be, I would say, penalized because of a lack of products or a lack of resources. So we're going to offer that. And what we're going to do for you, and which we hope that will extend on to the borrower, is extend some discounts. How about that? I'll say it that way. Credit cap fees is what we call it here at Freddie Mac. And basically what that says is that we're not going to charge you at any credit caps, any credit fees. So on a first-time home buyer that's 80% or 100% area median income, now that's whether it's home possible or not, on our standard products. If they're at 100% of the area median income or 120 or below in designated high cost areas, we're not going to charge. So that means that's a savings that you can pass on, not that you have, that you can also pass on to your borrower. For a home possible mortgage, which is our product that's with 80% or below area median income, no credit fees on that. And then on certain duty to serve mortgages. So we have some duty to serve products. And there are certain areas where you can lend in those areas, especially those rural areas. Some of those, they don't have credit fees either. So we want to make sure that we're giving not only the borrower something, that we're giving something to you. And one of the things that we're going to just ask you to refer to Exhibit 19, because that's where you'll see all of the information. And when you get a copy of this, the hyperlinks in this deck do work. So if you'll click on those when you get this, you'll have, it'll take you right to all of that information. And then of course, if you have any questions, please feel free to reach out to us. And in closing, I just want to say thank you again for this opportunity to come before you to talk about these great things that we're doing here at Freddie Mac. We really appreciate and we value the partnership that we have with all of you, and we want to continue that. So if there's something that we can do here at Freddie Mac to make your life easier, to make your life happier and better, please let us know. We'll be more than happy to either tell you maybe we do have it, or we'll look into it and see what we can do to make that happen. So thank you again, and I'm going to turn it back over to Paul.
Thanks, Mia. That was awesome. Ton of information and super helpful and great segue again here. I was going to say as a reminder, but I didn't mention it, so it's really the first time. We are going to be providing this slide deck as well as the recording of the webinar probably later this afternoon for all the registrants. So cruise through it, and as Mia said, these links are going to be workable, and yeah, have a look at it and go back through these slides. Lots of information in here that'll be, I know I'm not going to remember it all, so I'll have to go back through it again too. But no, thanks again, Mia. That was awesome. So with that, that segue, Mia mentioned on one of her slides there, easier to do business with Freddie. And what I'm going to talk about a little bit here is the technology solutions that they've provided with what they call SMA, Secondary Market Advisors, which MCT is one, and a great partner of Freddie Mac's. And these technology solutions for us at MCT is API. So API just is a bridge between two technology platforms. So MCT Live and Freddie Mac. And what we've done at MCT is we've developed something called Rapid Commit. Rapid Commit has been in place for a few years now, and it's been a great success for everybody selling to Freddie Mac. And you can see these stats over here, pretty impressive, right? For those retained and CTOS executions, so that's that co-issue and retain. We've done over 100,000 commitments for almost $80 billion, and this was as of August. And so I'm sure we're above 80 billion now, which is exciting. And then we also have the cash released exchange. That's that co-issue product that Freddie Mac offers, and it's a best X between several co-issue partners that Freddie Mac has on their platform there, and that's 54,000 commitments for almost $16 billion, which is awesome, right? A lot of action going through those two executions there. So, like I said, these are made possible by those technology solutions that Freddie Mac offers in this API integration, where you can come into MCT Live, commit loans in seconds, and then we take that commitment information, push it back into your LOS so you can get started on the post-closing process to get that information over to Freddie, get those loans purchased, and move on to the next one. So, Ian, let's switch to the next slide there. So then, part of that, to get to the point where we are committing those loans, obviously there's a best execution process. There's a process of making sure that we have all available information to commit this loan to the right execution, to satisfy, finding the right product and then committing it to the right way. So with another integration that we have with Freddie Mac is an API that allows us to bring in all rate sheet possibilities, all rates, all lock terms, and all products. And so that way you can do a proper best execution, making sure that, am I committing this to the right spec, the low loan balance spec, the home possible, is it a green loan? What can we do there as far as like identifying green and committing to that? So with an API, we're able to, from Freddie, we're able to take a group of loans and pull in all the possible executions and show you which one is the best one to commit to, and then you obviously commit to that through Rapid Commit in MCT Live. But with that, the other API that we introduced earlier this year, or that Freddie rolled out earlier this year, was this income limits API. And so what we do with that, we actually take the information passed to us from our lenders and ping this up against the income limit API to get area median incomes. Now, through that, our LOS connections that our lender clients are setting up with us, we're pulling in that borrower income, and then we can judge what is the AMI percent. Mia just talked a lot about 100% caps, 80% caps, all those caps that come into play on your LLPAs, those loan level price adjusters. And so now that we're able to get the area median income, and then we're able to obviously do the easy calculation of the qualified borrower's income compared to that AMI, we can then fire an LLPA cap to make sure that when you're comparing pricing to other outlets, making sure that, number one, you're committing to executing to that LLPA cap. But number two, as you're offering this on the front end through your pricing engine and locking that rate in with borrowers with no LLPAs, you're able to kind of see that throughout the mark-to-market process. Unfortunately, as you all know, you process a loan, incomes change, and weird situation, income goes up, maybe it doesn't qualify for that AMI cap anymore. So through our integration and passing this information into your mark-to-markets, you can kind of see those changes, and we report on those changes as well within MCT Live. then you also have duty to serve. You have those high needs rural areas, manufactured homes, all those kind of other products that that can also qualify for these LLPA caps with various AMI percentages. So we're able to pull that information in too. Lastly, that's become a big issue this year. It's been a big issue of something that MCT's focused on a while now, but it's this protecting of the NPI. And so when you combine that loan number with the borrower name, the credit score, and the property address, we need to be protective of that. And so we take this very seriously in MCT. And what we're doing is we're making an effort to pull in geocode data again with these income limit APIs that Freddie Mac offers. And a couple other solutions here, we are able to pull in some geocode information. And our goal is to have that geocode information be the pricing driver of the loan when it comes to the geography of the loan, right? Mainly, what are we trying to do there? Strip out the property address. You know, obviously property addresses can be public information, but then again, combining with that borrower name and those other key data points, that's where it becomes very sensitive piece of information. So we want to strip that out so your data is secure at rest there. And you're not passing this around to all of your partners out there, and you're only sharing it with the folks that are going to ultimately end up owning the loan. So through, again, those income limit APIs, we're able to pull in that geocode information to get us to our goal of protecting your borrower's data and stripping out that property address from bid tapes and other information that goes out. We've had quite a bit of success, and it's still growing. Our partnership and use of this API is still growing. And so on the next slide here, we have a nice little quote from one of our clients in a case study that we've done with one of our clients here. And so you can read through that as I'm closing up here. But again, this just passes through the confidence that when you're locking this on the front end, you're able to see, you know, it doesn't qualify for these LLPA caps, and am I executing into the right place on the back end, because I know the LLPA caps will come into play. And we'll keep growing and using these APIs that Freddie has to offer. We're always first to raise our hand at MCT, and Freddie's been so generous to share this with us and other SMAs, and they're continuing to innovate as well. So I'm excited to see where the future takes us on this, making it easier to do business with Freddie. And in this time of limited inventory, both in the mortgages and on the housing, obviously, you know, for most of us on the phone, it's probably on that mortgage limited inventory there, opening up more solutions, more loans, so we can attract more borrowers to kind of get us some volume in the door is what we're trying to do here. So. Again, I want to thank Ajita and Mia for joining me on this call today. They had much more valuable information. Mine was short and sweet, which is good. Let everybody get back to their Thursday here, and we will be providing this slide deck and this recording after the fact. And so I look forward to any comments or follow up from you. I'd never mentioned that we would be taking questions. If you want to stick around for a minute, and you can post questions into the webinar, we can follow up with some answers. I think you know, we won't follow up here live on the webinar, but if you want to post any questions you have or comments, please fire away. And like I said, we will follow up with you after the webinar in a direct message here. So thanks again for everybody that attended, and I look forward to the next one.